Hello and welcome to the Switzer Report September webinar. I'm Paul Rickard and joining me today is the founder of the Switzer Report and guru, Peter Switzer.
Thanks, Paul. It's the nicest thing you've ever said about me, calling me a guru.
Well, you are a guru, so you're seven expert, seven secret stocks. So yeah. So also joining us today will be June Bailu. June, of course, is from Tribeca Investment Partners. Just having a small technical issue while June joins us, so we're going to carry on, but she'll be with us very shortly.
And we always set the scene anyway, don't we, before we start asking questions?
We do. So let's just set the scene and start with a couple of important messages. I like to say messages from our sponsor, but they're not. The first one is the obligatory disclaimer. Now, this is, I'm being a bit joking when I say obligatory. It is important because we don't know anything about your personal situation, financial needs, or investment objectives. So while what we say we think we're giving you is brilliant financial education, it may not be appropriate for you. So if in any doubt, we always recommend that you speak to an independent advisor before acting upon anything we say. And that's really what the disclaimer says. So just because it's suitable for someone else does not mean it's necessarily suitable for you. So with that out of the way, a couple of other housekeeping matters. First of all, this is an interactive webinar. There'll be a chance for you to answer questions. We've already got some in and we'll get more questions as we progress. But so to do so, you can either send them in on the right-hand part of your screen, or you can click on the raise your hand icon, in which case we'll come to you and providing your laptop's got a microphone, we'll unmute you and you can then speak directly to us. So that's the way we actually like to get questions. The reason it makes it a bit easier is it makes it easier for anyone else listening as well. And so we encourage you to use the use the raise your hand icon.
Yeah, and we're encouraging you to get involved in the program. We're all friends after all this time, so it'd be great to hear from you.
Okay, and also you can just click on the Q&A to type out your question. I've also got a lot of written questions that came in beforehand. We'll get through some of those beforehand. But first of all, welcome, June. How are you?
I am very good. Apologies for a bit of a technical difficulty earlier.
Yeah, I think that was really at our end. We probably gave you the wrong steer, so apologies to the Switzer team.
June Bay is perfect. She never makes a mistake, Paul. That's why she's on the program.
Okay, all right. Just before we just go, I want to have a quick recap in August, but just reactions to what we saw in the US last night and a little bit on today in terms of the US futures market. So I might start with you, June Bo.
Yeah, it's actually fascinating. We were expecting a bloodbath this morning. While the market was down, of course, and there was a broad-based sell-off, the train wreck in the tech sector was not as bad as expected. We actually seeing a bit of buying by the dip coming through, which is very fascinating, which I would name it as a healthy pullback, and you see people are buying the dip at this point.
Do you think there's more to come?
Look, market, absolutely. We'll see a lot of volatilities. Market has done well, and we have the earnings now slowly recovering. And then we still have a lot of uncertainties. Absolutely, we have volatility, but remember, these are buying opportunities.
Okay. I was actually just telling to Peter. I just was writing something and I called it the blow off top, and I forgot there was actually a technical term for a blow off top, which is. Does come after a very, very strong appreciation, very quick appreciation with what we've seen. Having a bit of a blow off top and a sharp decrease is not it's quite a normal sort of chart pattern. So,
and June Bay, I think a lot of people have to understand that the US in particular, its market has really been powered along by the FANG stocks and the other kind of high tech stocks. It only makes sense that there be fund managers taking profit. And there could easily be a period of rotation into stocks that were ignored in the past. And I know only a couple of weeks ago, it was reported that Warren Buffett had made a pretty big bet on Bank of America. So, and that's the kind of stock that would benefit from a rotation, wouldn't it?
Yeah, absolutely. You know, the cheap stocks, the stock that hasn't outperformed, you started seeing a bit of that in the last couple, well, in the last few days, you started seeing a bit of it. And last night in the US just seems quite aggressive. Everyone decided it's time to sell the tech, take profit and put into something else. And last night we actually saw the airline did okay. And, you know, the reopening trade, if you like, the company that was left behind sort of have done okay on that basis. So clearly, you're absolutely right. The extra return that's going to you know, support the market in the next 3 to 6 months will come from those stocks. But look, that's not to say tech companies not going higher. It's just a healthy pullback, like you put it at the beginning.
Okay, let's just go back quickly to August. Does seems like after you turned your way, it was only the 31st was Monday, and we'll just go through that in the sectors and just look at some of the reporting season things. So I think the interesting thing on these data, of course, is the Aussie market still a long way from our highs. So we have yet to make up being the black for 2020. The other thing there, it strikes me, is the outperformance of the small caps and the mid cap 50s. The top 20 is still lagging, and this elusive sort of mid cap 50 stocks, which the stocks ranked 51st to 100 in market cap. I guess Afterpay sneaks into there at the moment. Yeah. A few of the other tech darlings do as well. They're actually up 3.2%. So
for the year.
For the year.
So that means, you know, they've kind of ignored the coronavirus, isn't it? Because we could have easily been in a normal year and the mid cap could have been up 3.2%. We would have said that's pretty good. And by the end of the year, it might be 6 or 7%. So it's interesting that these sorts of companies have resisted the negativity around the coronavirus.
Yeah, any thoughts on that apart from the underperformance of the big cap stocks?
Yeah, look, I think Afterpay is a big contributor to that mid-cap performance because Afterpay is a very, very big mid-cap index weight, big stock now. In fact, its market cap is actually as big as the top 20. So a bit surprising, actually, you know, S&P announcement index changes didn't quite include Afterpay in the top 50 stocks. Yeah, so the mid-cap does consist quite a bit of tech companies. Tech and gold generally dominate the mid-cap space, and that's hence why they have done quite well. And the large cap, like you said, they just underperforming. It's dominated by banks, and it's interesting that CSL now being the largest stock actually now is underperforming quite a bit, simply because there's a bit of a challenge earnings outlook because of the coronavirus impact, and it just did so well the last 2 years. Bit of pullback, so yeah, it's a relative game. So mid-cap's done incredibly well.
Okay, let's move on to the sectors. I think there's some interesting insights in the sectors as well. So we have the 11 sectors, their weighting and performance in August and year to date. So no surprise that IT up 35.7% year to date. That's not bad. That's Afterpay. That's Xero. It's also REA.
Does Tyro get into there?
No, Tyro's not in that. Not yet.
Financial, is it?
It's Tyro's in the tech, or is it in the tech? Yeah, it's in the tech sector.
Yeah, it's still really low weight because it's still a new stock, but it's principally the Xeros and the Afterpays and a couple of others in there as well. Materials, which is your iron ore up and gold up 5.5%, not bad. And then consumer staples, which is your Woolies and your Woolies and others are benefiting from strong consumer sales, as is consumer discretionary, which is largely a function of the strong performance by the retail components. So, and then on the other side, we've got very negative performances from real estate, utilities, financials, energy, and even the industrial sector. So very mixed. You know, the difference between the winners and losers is quite stark this year.
Yeah, it's incredible, isn't it? and then see some of the reversal in August reporting season is interesting as well. You know, when you actually look at the earnings, real estate, for example, they didn't report good numbers, but share price rallied regardless because of this reopening trade of things might get better from here on. Discretionary, clearly, they all had a great time because the stimulus clearly has been spent on the discretionary names, and some of them actually declared really big dividends. So that's interesting. So it's but what's fascinating I find in this environment is the communication services. I don't know if you thought, because communication services meant to be really defensive. It's dominated by Telstra and TPG and those telco names, and there's media, of course, a few others. But the big index weight in that space meant to be the defensives of the world. So, however, if you look at year to date, they're still negative. It's really just a demonstration of that space. It's just so competitive. We thought the competition would go away with Vodafone and TPG merging, but the competition is heating up again. So Telstra reported some of the worst result. So it's a challenging space. Interestingly.
Okay, let's go on to reporting season. Best and worst. So the top 2 or 3 for you from reporting season, June?
Look, the best will be, any company to do with online e-commerce related businesses. They have delivered, many of them, doubling and tripling of their earnings. You look at Kogan has been fantastic. Afterpay has delivered phenomenal user growth and merchant growth globally. And that's just been fantastic. I must say some of the retailers delivered very strong numbers too. You've got Harvey Norman delivered strong numbers. Not only the top line strong, the bottom line has beat consensus by double digits, aside from a special dividend. So look, it's I think definitely the discretionary end and the tech space has been incredibly strong. The worst, I must say, the banks, they're not really delivering anything inspiring at this point, nor were there much expectations going to the results, but then they still came through just a little bit softer in terms of what's going, in terms of the outlook as well as the underlying metric. What's also interesting heading in this reporting season was, some of the travel names and shopping center and a lot of these, they delivered the numbers actually not. It's actually beating expectations. And these are the sectors being impacted significantly, which is interesting because the expectation has been hit or has already been revised down. And so they came out and we're actually seeing earnings upgrade for those names. So on this basis, you saw the share price rally for these names, which is very interesting.
Yeah, well, corporate travel was one that really shocked me. It's gone through a pretty big ride, hasn't it, since reporting season?
Oh, absolutely. It's done so well. Look, it was smashed. It was sold off so much in the previous month. So it's a bit of a rally back. But Jamie was very bullish at the result call. I think he's right. He managed, as long as he can keep his burn rate low in terms of cash burning rate, and he will survive without the need to raise equity. And when things does get opened up, he will see that uplift quite quickly. And I think Flight Centre kind of sits in that space as well. If anything, I think Flight Centre hasn't re-rated to the extent that Jamie has or the corporate travel has. So look, they look interesting, but the earnings is going to be far away. You won't see the earning returning until at least 12, 18 months. Or it could be a 2-year journey to get to the pre-COVID level for some of those companies.
Do you think the market, though, has already priced in the recovery to a lot of these stocks? I mean, market's always looking forward. We're looking forward 6, 12, 18 months. I mean, I can't see how they're any closer to recovery today than they were 6 months ago. But do you think, what's your take on that?
Oh, absolutely. I think that's a really good question. I think it's true because if you look at what some of those travel companies, so say the corporate travel, what is it trading on now? It's trading on a pre-COVID level multiple, of closer to 20 times, 18 to 20 times now. So look, that multiple probably looks cheap compared to what other companies are trading at the moment. But look, you are start pricing in the recovery. And what that means is that if we have a hiccup in recovery, these companies can get sold off very quickly, just simply because we don't have earnings yet. All the expectations can change quite quickly. So expect volatility in those names.
Okay. All right, we might move on.
Go to questions. No, I think we should go to questions. Yeah.
Okay, we're going to start with lots of questions on some. We'll knock over some of these first. So let's look at the couple that didn't report badly. We've got questions from Jacob, Mike, Zoe, and Sarah about Telstra, which has surprised me. It's actually done as badly as it has a little bit. But I'm going to throw that over to you, June. What's your view on Telstra?
Well, it's a bit hard to like it. Look, people got excited ahead of the results. So share price actually did quite well leading up to the result, which is normally a bad sign because it means if you don't meet the expectation, you'll get sold off. Now, people were hoping the competition would ease off for the mobile markets. But sadly, just before the results, you saw competition picking up. The new TPG started discounting the mobile plans and all of that. So it doesn't bode well for future earnings. So it's hard at this point. If competition doesn't stabilize, it just means the earnings not going to grow this business. And another thing is that the dividend, while the dividend looked pretty good, so think about it, it's not going to grow. And secondly, it's paying more than 100% of its earnings at the moment. Telstra actually raised at the result and talked about maybe the dividend is not sustainable to be paying more than 100%. So they may even scale it back. So you're looking at a shrinking dividend. Look, it's stable, share price being sold off so much. It looks okay, with your just over 5% dividend yield, close to 5%. But that dividend will get cut somewhat just because the earnings really not growing.
Yeah, the analysts think it's got about 21% upside, but that's their best guess. From my point of view, if it got down to $1.70 again,
$1.70.
Sorry, $2.70. Yeah, $2.70 again. Would you be interested then in Telstra?
Look, yes. Look, I think it's good to buy Telstra for some income.
Yeah.
To me, I a little bit prefer to buy things like the shopping centers and they're a little bit high risk at this point because there's no earnings and things. But I know the earnings will recover. And then for these companies, they also are defensive, and they, their earnings will grow for the next 2 years, whereas Telstra earnings will shrink. So look, if it's for dividend, you want a dividend, that's probably where you can go. But yeah, it's not very exciting.
Yeah. Okay.
Well, I'm going to say I think it's getting into buy territory, but
but you're probably more boring.
Yeah, I am more boring.
Yeah, and a lot of our investors are boring. And I think $1.70, I would probably jump in.
I think the analysts have been horribly wrong on Telstra for so long.
Yeah.
So they got so excited about 5G, and I said 5G is interesting, but translated to revenue. Now the analysts sort of don't like it, and everyone's worried about, cutting dividend, which it might do. It's sort of though, it's because the market doesn't like it again. I think it's almost likable. But
I think you're right though with Telstra. There's another catalyst in the future is the separation of the infrastructure assets, and that can generate a lot of value. We don't know where it is. So it's going to take a while, but that's a possible catalyst, positive catalyst that's coming up. I think do remember as a retail investor, you kind of look at absolute return model. So downside for Telstra is probably limited. I agree with you. It's in the territory where no one wants it. It pays a good dividend yield, and its downside is probably reasonably protected. But for me, as a professional investor, I have a benchmark, so I need to buy a company that will outperform the market. So on that basis, I kind of feel Telstra is a little bit harder. Yeah. But for a retail investor, your downside is reasonably protected.
Sorry for bringing you down market, Junbei.
Okay, let's go another unloved stock, which maybe might get loved again. It's certainly bounced last couple of days, given that finally going to be broken up. AMP. Do you think there's value in AMP?
There's another one, just like Telstra.
Look, another dog.
I wouldn't touch it. But they don't even have management team. So look, it's they will try and separate out the assets, yeah. And companies going through enormous amount of challenge, structural effect, well, structural challenges, structural headwinds. Now without management, now they have institutional investors pulling money out of their funds management group because of what's happened with the group. You will have significant review and restructure of this business. And quite frankly, I think this, AMP Capital within that group is probably the jewel in the crown. And, if you do sell that bit of business, what about the rest of the business? What's there? So it's very hard to assess. But, if anything, that separation could potentially generate some value. But to me, I put that into too hard basket. I don't need to.
I think it was some of the parts, because I think the best outcome that's happened is they're going to break it up. That should have happened 2 years ago. So I think there's value because it can be sold out. I think the current strategy is just nonsense. So, okay, let's go to some questions. Another stock that I think there's value in, but I think you're a fan of this too, is from Hugh. It's about A2 milk. His question is, do you see the current problems with China affecting A2 milk? Or is the fact that it's a New Zealand company a mitigating factor? And just
Look, we have gone through this a few years ago when China first, when we first had a bit of, uncertainty, geopolitical uncertainty a few years ago, and I think it was very clear back then that A2 is a New Zealand company, and they source from New Zealand. Well, there's some from here, but source from New Zealand, processed and they're sold to China. So it is clean. It is a New Zealand business. Now, there's parts of it being bought from the Australian supermarkets and ship it through the Daigou channel and over there. That channel has already been disrupted, and, there could be more disruption if there is any issue or escalation in uncertainty. But look, it's a New Zealand company. It's good. I see value in A2, and you always want to buy those quality companies when no one wants to touch it because it's not very exciting at the moment. It's done so well in the last 6 months. It was so defensive during the market sell-off. It still grew earnings double digit, even during this, the Corona affected world. And to me, strong balance sheet, lots of cash flow, can take advantage of what's happening at the moment. US is doing a bit better. This company, to me, it's a multi-year.
So why is it sort of been hit since reporting season? Because I think it got overvalued before reporting season. It got up to over $19. But why has it been hit hard since it reported?
Yeah, because look, it's this reporting season was a very clear theme. Like we said, people want to buy the reopening theme. They look ahead in the next 12 months going, what's going to outperform? So it's almost the things that, aside from the tech sector, it's almost the things that's being sold off were the ones that got bid up. So even though the earnings were significantly hit. Now, A2 has did so well. There was a bit of concern that whether there's a pull forward in pantry stocking, because China are here, mother were buying all these infant formula, whether they will be a little bit slower in the next quarter. Possibly, but they're still looking at high single to double digit growth. So that was really just a relative call. So investor taking a bit of profit off and then put into something else. And then I think that escalation in terms of the geopolitical uncertainty puts pressure on all of these themes, right? Especially after you see what's happened with the wine industry. So it's essentially just the sentiment at the moment is turning towards other stocks, and there's just at the moment there's no interest in this.
What kind of 12-month target do you have on A2, Junbei?
Oh, A2, I think you can make at least 20-30% in the next 12 months. First quarter is your buying opportunity is now until the first quarter. So first quarter, there's a possibility it might be a little bit soggy, just because last year first quarter was very strong and there was a bit of a pull forward. But I'm pretty confident that it will come through over the next the following 3 quarters.
Okay, you mentioned wine. That gives me a segue into a question from Ang about TWE, Treasury Wine Estates. I hadn't realised it got down to $9.11. So it's really plummeted.
It's called the China syndrome.
But what's your view on the TWE? Do you touch it at these levels?
Oh, to be honest, every now and then I do try to pick those value, those quality brand names. I like it. Look, there's a lot of issues with it. Like, the company has gone through, company has wine in the US, and China are the two biggest market for this company. And, gone through a lot of challenges with the US. In the latest result, US is still very, very tough. Now, put that aside, China, Asia was so strong. The recovery from the coronavirus related interruption was phenomenal. So that's why share price rallied so hard, post result. Everyone want to buy it because on a 1 or 2 year view, this company is looking very cheap relative to other similar sort of companies. And Penfolds is a great brand. The brands like that you don't come across every day. Now, of course, China now looking into Australian wine and all that. It's going to take a year. So that's uncertainty, which means it's probably in the too hard basket for a lot of people. But my view is that if it goes to in the low 9s or even below 9, it looks very interesting. But you have to sit there for a little longer because we don't know, how long this process will take. My view is still that Penfolds is not really a, cheap wine to, to be dumped into the Chinese market. It is highly demanded, and consumer really love that brand.
Also be dumping some bin 389 on me, but. Well, I'll probably even go for the Grange or two, but anyhow, okay.
You can see what kind of cheap taste poor Rickard's got.
389's okay, it's $100 a bottle these days.
I'm saying.
Okay.
There are normal people out here who don't buy $100 bottles of wine, Paul, but go on.
Well, they also have some less favourable stuff. Okay. All right. Well, I could have just gone for the Grange. Okay. Let's keep going. So I haven't got any hands up. Have I? Just talking to my trusty assistant here. No, I have. Okay. I'll just ask you a question while we're doing that. We've got to talk about the 4 banks. So I think you mentioned that earlier. You're still not keen on the banks need to be. That's your view, June?
Yeah, look, I'm not keen, but again, they sit in that value bucket, and they're very cheap, but the earnings not going to grow. And at this point, the reporting season, what we saw is that, well, the bad debt hasn't gone up because we have so much hardship assistance at the moment, and people are not paying their mortgages at this point. So that's not really in the bad debt level. So we really have to see how our economy recover from this recession in the next 3 to 6 months. Even the banks don't know what it might look like. So their fortune is tied to our economy, and if that recovery is going to be prolonged, the bank's just not a good place to be. The dividend will come back, but not. Oh, well, as some of them started, ANZ paid a small dividend, but we don't see the dividend come back in a meaningful way this calendar year. By next year, you should see some gradually coming back as our economy get better.
Okay, Peter on the banks.
Well, I want to ask June Bay when she would get excited about CBA. At what price would you give in to a boring company like a bank and buy?
Oh, I tell you, look, I hold some banks, but I hold less than what's in the ASX.
Yeah.
So I have because they're cheap, right? They're cheap. They eventually will pay some dividend. Because the reason I hold some banks is that when the market does go through a big rally, so if we get a vaccine, for example, and when the market gets a clear view that we will move past this, pandemic, you will see an enormous rally in those sectors that's been sold off that has underperformed. And the banks is the cheap way to play it. There's energy that will rally, banks will rally, and of course there's shopping centers and REITs will rally, travel companies will rally. So it's those, and banks probably the cheapest at this point.
But Jun Bei, you didn't answer my question. At what price would you buy CBA? It's $66.94 now. Would it need to be under 60 for you to get really excited about the banks?
Sadly, CBA is like the most expensive bank amongst them all, like a really expensive one. Yes, I would buy more banks. If I see another I don't know, another 5-10% downside, but I guess I probably will always say that as long as they're going lower. CBA is defensive, very defensive, quality company. But if we have all the banks rally, that's not the ones you want to be in. You want to buy the cheaper banks because they will do better than CBA.
Okay, let's go. Thanks. Let's go to Dale. Do I do that? Yeah, you do. Dale, you should be able to hear it. You should be unmuted now.
So what's your question, Dale?
Hang on, he's on mute on my thing. No, keep going. Okay, we can't hear you, Dale, so we're not sure what's going on there. Let's go to George.
So George, shoot.
Okay, you should be okay now, George.
Can you hear me?
You're fine. Yep.
Okay.
Yeah. Look, this is a basic financial question. I'm not concerned about the financial position I'm in. I'm sound there, but I've got a sizable term deposit due, and interest rates are poor. You know, is there any good LICs that I should be looking at?
So listed investment companies that might provide a nice steady income flow.
Yeah. Yep. Thank you.
Right. Look, I must say LIC is an interesting space at the moment. It's most of them haven't performed very well because they have a huge discount to to what their real asset value is at the moment, most of them, and it's been a challenging market. And one thing you can be assured is that there won't be many LIC coming over the next many years. Now Magellan has a very interesting sort of LIC where you can actually redeem it in the unlisted trust, in the unlisted space, so it's stapled, so that will be then a better value. However, to be honest, I'm not very cross on that, in terms of what yield that it does offer. I think you can look into some of the ETFs as well in terms of income. But do be mindful that some of those companies, those ETFs have cut their dividend, has been quite challenging.
Yeah, I mean, look, you probably could look at Switzer. We could name it SWTZ, which is effectively like an ETF. But there are some licks out there that you could think of. There aren't too many specialising in just income, but
I think the interesting point is this, that we're associated with Switzer, and Junbei Liu has actually made the point that dividends are going to be under challenge for some time, and so a fund that might have both dividends and growth could give you a little bit more options, but it adds in the risk factor. And I know that people who bought into Switzer because of the coronavirus, that went as low as was about $1. It went down to 95 cents, didn't it? It's about $1.22 now. Now those people have really bought in for dividends, but they've got capital gain as well. I think, if you want to get away from term deposits, a lot of the income funds are going to find it very hard to do much better than 3% plus franking. You agreed, Paul?
That's about the return you should be thinking about going forward.
In the short term,
I would think so. Yeah. That's what you're going to be looking at. So,
but if the fund also has a bit of growth, its capital gain could be the saviour of you over the next year or two, provided we don't have another big market sell down. And that's the gamble you play when you move out of the safety of term deposits, George. But it's a really, once upon a time I would have said it's simply you can go into my fund or the Switzer fund, you can go into Vanguard, but they're going to be squeezed. Probably around 3% is going to be the best you'll expect for the next year. Then I think it will start to improve.
Okay, let's move on to Rami.
Hi, I have a question. It might be a little bit silly question, but I just need your expertise about it. If you like to have a portfolio for say the next 10 years, right, long term, growth portfolio, is it safe to have the majority of sector or the largest percentage in your portfolio in the healthcare sector, looking from the previous years out of all the other sectors?
Okay, I'll throw that one to you, Junbei.
All right.
What do you think of that?
Yeah, look, hi. Well, first of all, there's no question is silly question. You should see some of the questions I ask. In terms of running a portfolio, to future-proof your portfolio, it's absolutely important to have a bit of everything. I always believe that. Healthcare is really great sector to offer a bit of growth and also defensiveness. Now, but I wouldn't be putting majority of your portfolio in there because because sometimes, like we're saying, in the next 6 months it may well be some of the cheaper sector. Maybe, for example, property trust. They will deliver significant amount of return over the next 6 to 12 months. So in your portfolio, always have bit of growth, bit of value, bit of dividend. Sort of bit of everything to give you, the return you require. You need to get a bit of dividend every year, whether it's 2, 3, 4% every year, and then you need to structure it so it offers growth, the capital gain, the growth. I always have a little bit of growth companies in there. Healthcare sits well, but I also have some of the tech in there, and then you've got to have some of the cheaper stuff, and they deliver the the extra bit, if you like.
Yeah, I think you're absolutely spot on. I mean, it's interesting about healthcare. It's traditionally been considered to be as a defensive sector, but in the Australian context, it's actually been, if you look at the last 10 years, until maybe IT has just taken over, the best performing sector over the last 1, 3, 5, 7, 10 years. And that's largely because our healthcare companies are very specialised. They're global in orientation, and they're sort of single product or single. It's not just hospitals and big pharma. We've got, they're very sort of almost single product, singly specialised, and done really well. And that's one of the reasons our healthcare sector has grown a lot more strongly than, say, the US healthcare sector, which tends to be a lot more around sort of hospitals and big pharma, which are more almost considered to be defensive stocks, defensive areas.
Paul, you've always been a big fan of healthcare, and I've never looked at your portfolio because you don't show me. But I'd be surprised if your holding of healthcare is not even bigger than the index, because you've always liked it. And you can tell me if I'm right or wrong.
Yeah, but not that much bigger now. It's got up so much, and I think it's time for a change. It's not time for a change, but I agree that I think trying to say what are going to do best over 10 years is very difficult. And I think you stick to great stocks and you have a balance of sectors, because we see the markets just rotate between these things.
Yeah, and I think you're absolutely right. It's not about just top down saying I'm going to buy the whole sector. It's actually more about stocks. The companies that's actually going to outperform, rather than it's a top down, sort of sector view. Just get the right stock. It will make you so much more money than trying to get the sectors right.
Yeah. Okay, all right. Let's go to some questions. So I've got I'm not sure why there's questions are now on the screen in front of me here.
They're new ones.
Okay, but I can see that. Okay, right. So
maybe you thought your eyesight was a little bit impaired.
Okay,
so
I'll pick out a couple of these. This on healthcare. Ramsay Healthcare from Sean. Could you please give me your view on Ramsay Healthcare in a vaccine and expected possible pent-up demand for elective surgery?
Yeah, Tribeca.
Oh, that one's a buy. Ramsay, I love it. It's not only it's defensive, it's the reopening theme play. The stock, we are actually seeing the pent-up demand is coming through in all the states that has been reopened. Victoria is taking a little bit longer, but we know that's coming up. Backlog 12, 18 months. So this Ramsay, the private hospital, is going to run at 100% capacity. And then the thing is, remember, they also stepped up during this crisis, and they offered their, ventilated their facilities and staff to help out the aged care and, everything else around the world. So, I really think that all the pressure and attitude that the government has with the private hospital sector will change, because they will realize how important is this sector to, to assist the government in a situation like this. So I really think it's structurally, this company will have an earnings recovery and structurally will do better.
Okay, let's do another one. What do you think of the IWF deal to buy MLC from Richard?
Yeah, look, it's very, very accretive. The numbers they put on the table is phenomenally accretive. You know, in 3 years, it's something like 30–40%. So it looks really good on paper. The only issue at this point is, you know, it's so many years in the future. You know, we need, how do we get confidence that they will be realized? And especially, you know, those businesses are structurally challenged, and they've been, you know, essentially in disarray, most of those traditional businesses after the Royal Commission. So, you know, it requires a bit of a leap of faith to get there. But look, the company is not expensive, IWF, and this thing make them look a whole lot cheaper if they can realize those assets, those synergies they talk to.
Okay, let's go to, we've done the AMP question, so you can get rid of that one. I think that was a comment. Let's just go to the top one there, Bravura. So is it
up 54.9% according to the analyst.
Do you get involved in the so-called, you know, the platform stocks, June, right?
Yeah, absolutely. So, so you're talking about the Bravura, yeah?
Yeah.
So, look, the company, it's a good company. I love the company because essentially they digitize and help out all these large institutions to have a common platform, make it easier. And they've done very well in the last many years. But look, right now in the coronavirus affected world, a lot of those capex, you know, the capital expenditure that's being, you know, previously used to spend to upgrade those IT projects has been put on hold. So pipeline looks challenging in the next 12 months or so, but it's probably a short-term, it's really a short-term disruption, and eventually will come back. It just, earnings looking a little bit difficult for the next 12 months.
Okay, all right. I want to go to a different question here about Mesoblast. Lots of questions on Mesoblast have come in. So I know we've got a couple of people who really like Mesoblast. What do you, how do you, is that stock too volatile for you, June Bay? How do you think about Mesoblast?
It's not too volatile. It is a very volatile stock. With Mesoblast or similar sort of biotech companies, whenever they start to have clinical data and things, it represents a lot of risk because it's a little bit binary. If they don't hit the endpoint, the share price could halve. And if they do, share price would double. You know, it's that kind of volatility we're talking about. And then they had an announcement out today talking about, you know, extension of the clinical study for this coronavirus, well, COVID-19 sort of project. It doesn't really say that much. In my sense is that probably initial read is not great yet. We still have to wait to see. I just feel the share price is very volatile. It's pricing in some of those success of those clinical study already. So for me, I probably will avoid it at this point.
Okay, let's go to a question from, can we go to Heng? Sorry, I hope I pronounced that correctly.
Yes.
So Heng, you should now be unmuted.
Yeah, can you hear me?
Yeah, we can hear you.
Yep.
Okay. How would you rank the imaging companies, PME, IDX, TensorShell, and what's your buy, hold, sell ratings on them?
I'm sorry, I missed that company. What was the?
PME, Pro Medicus.
Pro Medicus.
IDX, and Sonic Healthcare.
Okay. You want to do all three, June?
I like some of them. Promedicus, amazing company, and you know, huge growth possibility. Super expensive. It's just very, very expensive company. You know, it's probably sort of company I'll put in my tech growth bucket. Right now, things look a little bit challenging in terms of earnings, like winning new contracts, because they need to keep winning new contracts. And because, you know, hospitals, coronavirus, everything's affected, capital expenditure has been put on hold. So earning might be a little bit softer over the next 12 months. But look, it's a great company. It's one of those things that you buy on a pullback. But remember, portfolio never have too many expensive companies. Otherwise, you become too tilted. In terms of Sonic, I'll go to Sonic. I think Sonic is, people tend to think it's a boring company, but this company actually, unlike many, is the beneficiary of this, of the testing and everything. They just signed a contract with the US government, and you know, potential possibility for them to get to the huge, the capacity, full capacity is enormous. You can be looking at huge earnings upgrade by this, by the AGM, which is probably in normally October or November. So this company's earnings looking very strong. But of course, it's the short term, it's coronavirus related testing and things. But for now, you know, it's making money. It's bringing.
I like Sonic. I mean, it's pretty diversified. It's got about, it's as big in the US and Europe as it is in Australia. And it's actually one of the few companies in Australia. There's a couple and outside the IT sector, which is above its sort of February, March pre-COVID-19 peak. So yeah, it's obviously had a few other factors going for it, but it's a pretty it's also quite defensive too.
Yeah,
the type of things it does. So it certainly was provided some opportunities in March, April.
And the chart makes it look like a buying opportunity, that's for sure.
Okay, let's if I can ask people to just keep their questions to one stock, otherwise
too many.
so I'm going to go to Craig.
Hi, Craig.
Yeah, g'day lads. Just a question on medical developments, MVP.
MVV, not a company I know a lot about. I hope you do, Junbei. So
Yeah, well, look, I think with MVP, I have had, you know, a few years ago, I was an investor and I looked into it. So essentially, they have a product, I think they call it Green Whistle. Essentially, it's Penthrox. It's something that's used to reduce pain. And now, this product has been commonly used in Australia in those emergency vehicles. So when people had an accident, you put the shot of Penthrox, and then you'll be, you know, you won't have pain, and then, you know, and then you go straight into the surgery. Now, so company has that. Now, this is not commonly used in other markets because they are actually banned, this product. So in Europe, the reason it's banned, actually, bit of history is, the reason it's banned is because they used to, Penthrox, if you don't use the right amount, people can die from it. You can get heart attack. That's a side effect. So in the 60s, it was banned globally, except Australia, because we worked out if you have the small dose, it's perfect. So so they started getting you know, approval in the Europe and many markets, and it seemed pretty good. So they started selling it to the European markets. But now the big thing for this stock to go anywhere is about US. And the FDA, because well, FDA is the medical body that approves those drugs. Because it's been banned many years ago, it always takes longer and harder for them to say yes to it again, even though it's been demonstrated it's safe to use. So, and then at the moment, FDA's got so many, well, spending all their resources on this COVID related. So that approval is going to take quite some time. So share price probably not going to go anywhere until that comes through.
Good, very good point.
okay, let me go to a question. A stock I know you're have been quite keen on, Peter, is around EML payments. That's from Peter. Would appreciate if you could provide an update on the short and medium term prospects of EML payments.
Well, I checked out with EML payments recently with Julia Lee, and Julia was a big fan of the company, still is. And I think this sort of fits the argument that Junbei Liu was mentioning earlier about the companies that will benefit from reopening.
These people do store cards and gift cards and things, right?
Yeah, yeah.
Yep.
And so, and also the cards that they use, they load up in casinos and things like that as well. So we know all those sorts of things, particularly in Victoria, aren't doing well. And they also have quite an international footprint. So I think EML is just sort of marking time at the moment. It clearly was looking terrific before the coronavirus. It had a nice bounce back. And I think that the fall away we've seen since July, gee, I think that's probably related to Victoria. What do you think, Junbei?
Yeah, I think so. Related to Victoria, and then just the recovery curve is a little bit slower. Has a big exposure to Europe as well. So, you know, in the next 12 months, if you take a 12-month view, things will get better. And this company, like you said, it's so related to shopping centers, shopping malls. When they start opening up, this company's earnings will rally pretty quickly. So they will see pretty good growth in the next 2 years.
Yeah, because the market liked the company. But the economy that it works in has been drastically changed, you know, for the moment. But I think it looks like a buying opportunity.
Yeah, I think so too.
Let me go to another stock that's a bit out of value. This is a question from Colin about AGL. Is that a stock that comes on your radar, Junbei?
It's a stock I probably will avoid. But I'm an institutional investor. So because I don't think it will beat the market, it won't do as well as the ASX 200. Mainly because, look, it's going to be very defensive because share price, they had a pretty poor result. Share price fallen, and that's about it. I tell you what's the main issue now with some of those stocks, especially coal related stocks. Globally, there's been this significant push to divest a lot of those coal-related assets. So, if you look at the Whitehaven coal and all of that, clearly the coal price has been fallen. But institutional-wise, it's just lacking interest for anyone to step into anything that's to do with that sort of sector. And as a derivative, AGL naturally is moving to that side. So to me, it's something for me to avoid. Just simply the investor base will get smaller and smaller in those stocks.
And of course, AGL still makes most of its money out of the Loy Yang power stations and the coal-fired power station in New South Wales and also down to Victoria. So that's where most of its profit comes from. So, and as I kept saying, it's so mishandled the government a couple of years ago.
That's right.
So, and they're still paying the price, and they're regulating the market pretty tougher. So it's, but you're not yet into that mainly because you can't see outperformance. That's your argument?
That's right. I can't see outperformance, but if the market's going to fall, this one's not going to fall as much.
And if you notice Junbei's technique, if it's an old blue chip, it doesn't look like it's got much potential. She's not very interested in it. But we should ask her about gold because a lot of people are interested.
Okay.
What's your view on gold? And if you do have a view, what companies do you like in that space?
It's fascinating. Gold is, again, in my portfolio construction, a little bit of growth, little bit of tech, little bit of value, little bit of reopening, little bit of dividend, and a little bit of gold. I always have gold in my portfolio because it provides that diversification. It doesn't move the same way as the market often, and it provides a good. So what's good about gold is that it's defensive against the market risk off, and also what it is it provides an inflation hedge as well. So it almost works on both ways. When there's so much money being printed around the world, the gold really holds its value. So to me, it's always something I will hold in my portfolio. Not a big position, but kind of in line, just a little bit in line with the what the ASX gold proposition is.
But would you buy it now on the supposition that the price could go a lot higher?
No. Well, yeah, over a long period of time, yes. So if you take a 12-month view or a 24-month view, yes, it's likely. But in the short term, remember when we talk about this rotation, if we have a vaccine, this whole reopening theme you see aggressive sell-off across gold, across growth, and piling into the stuff that underperforms. So just be mindful of that. Technically, at this point, there is a bit of risk to buy into them, but you got to take a longer term view of the gold.
Yeah. Okay, a question from on gold on Denise. Tanami Gold, TAM, you stock that you're on your radar?
Yeah, look, I don't know much about it.
Okay.
It sounds like probably a small cap. I tend to stay with a little bit more defensive ones.
Okay, and your best gold stock?
I still like Saracen.
Saracen, okay.
I like Saracen. It's expensive, but I like Saracen. The best of
SAR, just bring that up so we're here.
Yeah. All right.
Okay.
Yeah, look at this company. It's done well. Saracen, it's a bit expensive, but it's done. It's a best quality management team that actually delivered. Another one you should look at is Newcrest. Newcrest relatively underperformed the other smaller gold peers. It's cheap enough. It's got good reserves, so that one you should look at as well.
Yeah, Newcrest has also got big in copper and other things, isn't it? It's copper that's other main mineral. So it really hasn't done much. If you look at that chart, which is 12 months, given the gold prices rallied, it has underperformed compared to the other gold majors?
So I think you're right. I think like Newcrest will represent probably the best opportunity. They have had a lot of issues. They just had a result. They have another issue. So look, the execution isn't great, but that's why the share price underperformed. Now it does represent pretty good opportunity.
Okay, I'm going to throw this one to you first, Peter. A question from David, and I might also get you, June, to comment too. What's your best tech stock recommendation with a 3+ year outlook?
Okay, well, the tech stocks I like are Afterpay, but I think it's too expensive. And I like Xero, very much like Xero. But I like Zip, and not because my old mate Joe Hockey has now got a contract to represent them in America, but I think Zip is a good company. I think it's heading in the right direction. And I also like Tyro, if we can call Tyro a tech company. And that's why I had in my Zeets collection, Zip at one end, Tyro at the other. And I think both those companies, I think, will do well over the next 3 years.
But of those versus Xero, do you have a...
Oh, well, Xero is a safer play. I think if I'm going to try and make money out of it, I think Tyro is going to be the one that will make money for me. Zip, I think it's good, but there could be challenges. We saw PayPal come out and knock Afterpay around for a little while. There's still people talking about regulation. I don't think that, I think these guys will keep heading in the right direction, but maybe their big lift has already happened. I think Tyro's next big lift will happen when the whole economy opens up. And then I'll be interested to see where it heads. He can't say much because he's on the board of Tyro, but I do, and I know June Bay likes Tyro as well, but that might not be her favourite tech stock.
Okay, and for you, June Bay?
Oh, I like all these stocks and all of them. So I agree with you. I think Afterpay is a phenomenal, and I like Zip as well. I think that sector, like you said, it just does so well.
Between those two?
Between the Zip or Afterpay, Afterpay is a quality company, and there's enough support in there. You just constantly see buying whenever it dips. So, and then it's got Tencent sitting on its register. So, yeah. Look, it's double the price compared to Zip, but Zip is smaller. It's going to take longer to get to that kind of scale. So, yeah, look, I like both of them. Probably Afterpay at this point, look, and then in terms of others, Tyro, I think is amazing. I think Peter's right. The next 12 months or next 6 months, Tyro probably will be the biggest performer, just because it's lagged other tech names since result hasn't really done anything. So this company is going to do well when the economy opens. I actually forgot what you said, Peter, but
Xero is another one.
Yes, Xero, take a 3-year view. It's perfect. You just buy it and just don't worry about it. You know, this company will go places and they will dominate. You know, they're already showing great numbers in the UK, and US is still quite small at the moment, but you know they will deliver those numbers. So that's fantastic. Xero is absolutely there. Another one I like to mention is Megaport. It's expensive, but that company is one of the very few companies that offer you that growth exposure into that cloud space. Now, this company is...
The Megaport, we'll just bring that chart
I mentioned that on Monday.
Just to bring that up.
I think it was Michael Wayne from Medallion. He likes Megaport as well.
It's had a bit of a run this week. Yep.
Yeah, the Megaport, look, today, you know, in today's sell-off, it's a great opportunity to buy some of those names. They may have a few down days when the tech company gets sold off, but you know that will get bid up. So yeah, these companies in 3 years, they're a whole lot bigger than what it is today. And another interesting thing to point out is that a lot of these tech companies will always look expensive, mainly or partly because analysts are not very good in estimating earnings for those companies, especially if they're the innovator of their sector. You know, it's like, do you put 100% growth or 200 or 1,000% growth? You know, we're not very good in estimating it. So these companies will always perpetually look expensive. So you just need to follow the momentum in terms of, you know, the subscriber, the key metrics. As long as they're ticking higher, it's very, you know, these stocks will continue to perform.
And we often don't know what they're going to require as well. And they come out of the blue, don't they, those acquisitions?
That's right, yeah.
Okay, thanks.
Okay, all right. Well, we're almost out of time. June Bay, that's been fantastic. Thank you so much for joining us today.
And we should ask you, what's the name of your fund that you actually look after, June Bay?
Oh, I run a fund called the Tribeca Alpha Plus Fund. It's a long-short fund, and we've been around for 14 years now, and we're the top tier, manager in terms of performance, and we just had a great reporting season.
Good
And
stuff.
how do people invest in the your fund, June?
Yeah, they can just go to website, request the application form, or they can go to, my partner's Grant Samuel. They can reach out to Grant Samuel. So it's relative simple process.
Okay, and that's tribeca.com.au?
TribecaIP.com.au.
TribecaIP.com.
Yeah,
Investment partners. yeah.
Investment partners. Okay, sure. Okay, all right. Now, just to close, Peter, tonight, US nerves from last night, futures are down a little bit. US employment data.
Well,
Are people going to care about the US employment data?
yeah, I think I will. I think I will, Paul. Look, the one thing I really liked from last week, and I mentioned in the Switzer report, is that Ed Yardini is a very good US economist, and he said last week that the economic data is really heading in the right direction. And I think if they get a nice employment number, the market will like it. But the market needs a bit of reinforcement for all the positivity it's been showing. But at this point in time, month-to-month data can jump around like nobody's business. I just hope it's a nice big jump to get the positivity going.
Okay, you'll be writing about that in tomorrow's
Exactly. When everyone's
report, so
sleeping, I'll be up working.
Okay, as always, never sleeps.
Never sleep.
All right, look, that's it from us for this monthly webinar. June Bay, thank you much for joining us.
Thank you.
As I meant to say at the outset, we'd like to keep these to an hour exactly so that you know so how long we'll be. But of course, we'll be back on Thursday for our regular Boom, Doom and Zoom webinar. So join us Thursday, 12 p.m. Eastern Standard Time sharp. And of course, sorry, lots of opportunity there for some of the questions we didn't get through today. So thanks for joining us. Have a great afternoon and weekend from the Switzer Report team in Sydney. Thanks a lot. We'll talk to you next week.